Have you ever felt like you're doing everything right with your money, but still falling behind? Maybe you're investing regularly. Maybe you've picked a few ETFs because you heard they're safe, low cost, and smart for the long run. But then you see someone else, same age, similar job, and somehow they're way ahead. They're talking about early retirement or buying a second home, while you're wondering why your account isn't moving the way you hoped. I know that feeling. I'm Mark, and I've lived that gap between doing the smart thing and still feeling stuck. And here's what I discovered. It's not always the market holding you back. It's tiny, hidden mistakes inside your portfolio. Mistakes that don't scream at you. They whisper. And over time, they quietly drain your results. This video isn't about picking the best ETF or chasing the next hot tip. It's about avoiding 5 common traps, the kind that look harmless but can cost you thousands of dollars over time. I'll show you the traps I wish I'd known earlier and how to fix each one with simple moves that make your investing work better, not harder. But here's the twist. One of the biggest traps, it's not even inside the ETF. It's inside how we react when things get rough. And most people, even smart, responsible investors, fall into it without even realizing. Let's fix that. Let's make your money work smarter, longer, and with fewer regrets. Let me show you something that almost no one talks about. It's not about choosing the wrong ETF. It's not even about how much you invest. It's what happens when small leaks go unnoticed for years. You might be doing everything right. Investing regularly, keeping costs low, staying long-term focused. But even then, a few quiet mistakes can slowly drain your results without making any noise. No alarms, no red flags, just a portfolio that grows slower than it should. This is the dream versus reality moment. The dream is invest smart, retire early. The reality, a few little traps keep you stuck. And by the time you notice, you've lost years of growth. That's why this video matters, because we're going to fix those leaks. I'll walk you through 5 traps, the kind that don't look like mistakes, and show you how to avoid each one with simple steps. No guessing, no jargon, just a smarter way to make your money grow. And one of these traps is not even about the ETF at all. It's about how we react when the market turns rough. Let's start with the first one. It looks small on paper, but it adds up fast. Let's talk about a trap that sounds harmless because the number looks small. You see a fund fee of 0.75%. You think that's less than 1%. No big deal, right? But here's the truth. Over time, that tiny percentage can quietly cost you tens of thousands of dollars. It's not about the number, it's about the years. Let's say you invest $10,000 and add $500 a month for the next 25 years. Now compare 2 ETFs. One charges a tiny fee, just 0.03%. The other charges 0.75%, not outrageous, just higher. The difference in fees is just 0.72%. But after 25 years, the low-fee ETF might grow to around $410,000, while the higher-fee one could end up closer to $358,000. That's a $52,000 gap, all from a fee that looked small. Why does this happen? Because fees don't just cost you once, they cost you every year. And they shrink not only what you have today, they shrink what you could have earned tomorrow. That's the hidden cost of compounding in reverse. The brain ignores small numbers like 0.5% or 0.75%. It feels safe, but compounding turns them into real damage over time. So here's the takeaway. If 2 ETFs do the same job, don't pay more just because one sounds fancier or is trending. And now the next trap is the opposite feeling. This one makes you feel like you're winning every single month, but it can still leave you poorer over time. Let's move to trap number 2. High-yield ETFs that look like a win, but can quietly lose the race. You might see a fund offering 8%, 10%, even 12% yield. It pays you monthly, the cash hits your account like clockwork, it feels like a paycheck. But here's the simple truth. Income isn't growth. Let's break it down simply.
Total return equals price change plus income payouts. If a fund gives you a 10% yield, but the price drops 8%, your real return is only 2%, and that's after taxes. Worse, some high-yield ETFs pay you by doing things like selling options, using risky bonds, or giving you back your own money, called a return of capital. It's like getting a paycheck from your own savings. You feel richer, but your balance shrinks behind the scenes. Here's one example. Over a 5-year period, one high-yield ETF with an 11% payout ended up returning less than 2% per year after accounting for losses, while a lower-yield ETF grew over 10% per year. Why do people fall for it? Because monthly cash feels good. It feels safe. You can see it, touch it, spend it. But when you zoom out, the real winner isn't the fund that pays the most. It's the one that grows your wealth slowly and steadily. So before you chase yield, ask, where is this income coming from? And is this helping me grow long term? And now here's the twist. Even if you choose the right ETF, hold it for the long run, and reinvest everything, there's still a trap that can eat into your returns without touching your portfolio. It shows up once a year, in April, and most people don't see it coming. Let's say two people buy the same ETF. Same day, same price, same number of shares. But a year later, one of them owes more in taxes. Why? Because of where they held it.
This is the trap most investors never think about. Taxes based on account type. See, different accounts treat your ETF earnings in different ways. A taxable brokerage account means you might owe taxes each year on dividends or interest. A Roth IRA grows tax-free if rules are followed, so any dividends or growth inside stay yours. A traditional IRA lets you delay taxes until you take money out. Now here's a simple example. Let's say your ETF pays $1,000 in income. In a taxable account, depending on the type of income and your tax bracket, you might lose $150 to $300 of that to taxes. But hold that same ETF in a Roth IRA, you could keep the full amount. Over time, that adds up. If you're losing even $200 a year, over 20 years, that's $4,000, and that money could have been growing too. But here's why it slips past people. It's invisible. You don't see the tax drag clearly. You just notice your portfolio grows a little slower. That's why smart placement is part of risk management. It's not just about what ETF you buy, it's about where you put it. So here's a simple filter. Put tax-efficient ETFs, like basic index funds, in taxable accounts. Put high-income or bond-heavy ETFs in tax-advantaged accounts, like a traditional IRA or 401k. Use your Roth for high-growth funds you want to hold for a long time. And don't forget, if you sell and buy back too quickly after a loss, you could trigger a wash sale and lose a tax break, another quiet trap. Now let's move to the fourth trap. This one fools people who think they're being smart by spreading risk, but instead of spreading, they're just duplicating. You might think, I've got 5 different ETFs, I'm diversified. But here's the thing. If those ETFs all hold the same top stocks, you're not really diversified. You're just wearing 5 different hats on the same head. For example, a tech ETF, a growth ETF, and even the S&P 500 may all be heavily weighted toward the same few companies, like Apple, Microsoft, or Amazon. Let's say all 5 of your ETFs hold the same top 10 stocks. You might think you've built a solid structure, but you're really just stacking the same bricks over and over. That's the overlap trap, and it happens all the time. The reason? More funds feels safer. More feels like better, but it can actually make your portfolio less balanced and more risky. You can fix this with a simple check. List your ETFs, look up their top 10 holdings, count how often the same stock appears. If the same names pop up again and again, it's a signal you don't need more ETFs, you need different ETFs. Try thinking in roles instead. One ETF for your core market exposure, one for a specific tilt like value or small cap,
one for international if that fits your plan, maybe one for income if you truly need it. Each one with a purpose. The goal is balance, not just quantity. And now the last trap is the sneakiest of all, because it doesn't come from the ETF, it comes from inside us.
Let me tell you something. I've done myself, and it cost me. A few years ago, the market dropped fast. Headlines were screaming. Social media was full of panic. I told myself, I'll just sell now and wait for things to calm down. Then I'll get back in. But by the time it felt safe again, the market had already bounced back. I missed the recovery. And I learned the hard way. Feelings don't make good timing tools. Here's what most people don't realize. You don't need to miss an entire year to mess up your returns. Just missing a few of the market's best days can make a huge difference. One study showed that missing just the 10 best days over 20 years cut your total return nearly in half. Half! And those good days often come right after the worst ones, when people are most scared and most likely to sell. So why does this happen? Because fear is loud. Selling feels like action. It gives you a sense of control, and your brain rewards you for doing something, even if that something costs you long-term growth. It's not just fear, it's habit, it's comfort, it's thinking short-term in a long-term game. Now, how this hits you depends on who you are. If you're an accumulator, building wealth in your 20s or 30s, selling out early can cost you decades of compounding. If you're a planner in your 40s or 50s, panic selling can throw off your whole timeline. If you're a retiree, jumping in and out could mess with the income you rely on. That's why I've learned to set rules for myself, to take emotions out of the seat and let the plan drive. And that leads us to the final piece, how to build a simple, no-stress checklist to avoid all 5 traps and stay on track. If you made it this far, here's the good news. Avoiding these ETF traps doesn't take a PhD or a spreadsheet obsession. It just takes 5 clear rules. Simple, steady, repeatable. Here's the checklist I use, and you can start using it today. Fees. If 2 ETFs do the same thing, choose the one with lower fees. Small costs now mean bigger freedom later. Yield. Don't chase high income without checking the total return. A monthly payout feels good, but growth feels better over time. Taxes. Put the right ETFs in the right accounts. A smart fund in the wrong account can quietly drain your gains. Overlap. Each ETF should have a job. No duplicates, no freeloaders, just purpose-driven picks. Behavior. Set your plan before emotions take over, because your brain is great at reacting, but not always at investing. This is how we turn the dream of financial freedom into a reality you can build, one step at a time. You don't need to be perfect, you just need to avoid the big mistakes and let time do the heavy lifting. In the next video, I'm going to show you how to build a clean, simple ETF portfolio based on your life stage, whether you're an accumulator, a planner, or already in retirement mode. But for now, I want to hear from you. Which trap hit home for you? 1, 2, 3, 4, or 5? And why? Drop your number in the comments. I read every one. If this helped you feel more confident about your investments, consider subscribing to this channel. No pressure, just smart, long-term thinking to help your money work better. See you in the next one.